Well, good afternoon and welcome to our High Rock Weekly Client Webinar. If you do want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague Paul Tepsich, the founder of High Rock. Our certified financial planning professional and wealth forecast specialist Bianca Tomlinson is back to work, but she is also balancing motherhood and our clients' needs. And young Mason was in the office today on his jolly jumper. We were having a wonderful time. Well, each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit the home page on our website and click on the Introduction to High Rock Private Client button. We do have a new look to our website. If you want to have a peek, please let us know what you think. As you all know, our priority is to manage risk first and foremost, and currently we believe that we are in a time where investing risk is high and rising. We want to make sure that despite this, our clients have no trouble sleeping at night. So we are doubly aware of the current investing climate and all the many risks that are currently in play. It is extremely important to us that you understand the risk in your portfolio and how we are taking measures to protect you. If you wish to discuss risk in more detail, please do not hesitate to get in touch with us. Well, volatility has come off its recent spikes on North Korea and hurricane worries. Paul, any comments about what you're seeing as far as markets and volatility are concerned?
Well, increases in volatility certainly don't last long, do they?
Not really, but we all...
And spiking from 10 to 16 is really nothing anyway, and that chart is really only over the past year, but I know you've shown like a 10-year or longer-term chart in the past, but just to give our readers and listeners a background, in 2008, the VIX spiked up to somewhere in the 88 or 90 range. I could pull it up and tell you for sure, but this is really nothing. We're on the verge of potential nuclear war, and we've only got the VIX at 10 or 16. Kind of strange.
Well, it is, I guess, to a degree, somewhat interesting in regard to the fact that, we do get these lulls in volatility, then we get these mini spikes, but nothing of any consequence up until now, although, the months of September and October historically have been fairly volatile months. So I guess we just sort of sit patiently and watch how this all evolves. In the U.S., stocks are up, but bond prices are lower on the week, although the summer trend to lower yields does remain intact, and a lot of that has to do with inflation pressures just not being around. In Canada, stock prices are down, and so are bond prices. So correlations here are not really in sync. Paul, any comments?
Yeah, it's a big difference in Canada, isn't it?
Yeah.
It's a Bank of Canada raising rates twice within 2 months, and our stock market continues to suffer versus other stock markets around the globe. So we're back up, as you can see in that top bright green line. That is the 10-year Government of Canada bond yield on a generic basis. So you can see we're back up to where we were, around 2.05%. That's where we were back in July, the last peak. So we're right back there. At this stage, we'll wait and see and get a better read on some economic statistics before the Bank of Canada's next meeting, which I believe is October 25th. So it's about 5 or 6 weeks away.
Also, we've seen some significant strength in the Canadian dollar, and significantly also since the Bank of Canada kind of surprised, not completely surprised, but kind of surprised everybody last Wednesday. So the Canadian dollar is better against the U.S. dollar by about just a little under 12%. So that's been impactful to a large degree because even if you're invested in the U.S. market, when you do have to convert it back to Canadian dollars, it really has not um, had a significant impact. If you look at the S&P 500, the second from the top, you see it's up less than 1% in Canadian dollar terms over the course of this year so far. So all of that strength in U.S. equities really hasn't been able to benefit Canadians. And then if you look at the TSX, down 1.25%, you've got the bond index down by more than 2%. Balanced portfolios just haven't really had any ability to perform based on the fact that the Canadian dollar has been so strong. And that is a function, of course, of the Bank of Canada pushing rates up and a bit of a surprise over the last few months.
And Scott, just anecdotally, I just had coffee with a friend of mine who's a PM and has a similar business to ours. And he was just bitching and complaining. He just lost his entire year back down to flat because he was up about 10 or 12%, and the currency just wiped him out because he was all invested in the U.S. market, which was a good call. But if you don't hedge up that currency risk, boy, oh boy. So yeah, he just went from he lost it all over the past like 3-4 months. Gone.
Yeah. And you know, one of the things that we want to protect our clients from obviously is that kind of volatility. So uh, we do take a little bit more of a precautionary note when it comes to how we put our money to work.
Well, FX is one of the many risks we manage.
Yeah, exactly. And we've talked about that week to week, and I'll mention that again. But, you know, having a more tactical approach to investing does allow us to not have to depend on the old correlations, which are becoming less and less reliable, and not providing appropriate portfolio balance anymore. And this is, you know, something that we've built into our strategy. And, you know, while our strategy doesn't necessarily hasn't really had a stellar performance, we haven't seen any wild swings either. And for the regulators, we do remind everybody listening that the historical returns are no guarantee of future returns. But as you know, at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also remind all of our clients that we are working toward achieving your long-term goals as set out in your wealth forecasts. Now, these goals are certainly more realistic over longer time horizons than those that we might achieve in any single year. But if you wish to review your wealth forecast and your strategy, we are always available to do so. So just let us know. And of course, our themes for 2017, as we've often said, we avoid risk when risk is high, and we think that at the moment risk is high, and that means being more tactical inside an investment portfolio. The level of inflation or expected inflation is a key determinant for central bank policy, as is the liquidity that is in the system due to the recent years of extraordinary easy monetary policy. The Bank of Canada raised rates again last week. The U.S. Federal Reserve has raised rates by 0.75% since last December and may raise them again at least once more this year. Now, rising borrowing costs and reduced financial system liquidity may increase volatility going forward. So as we looked at that volatility chart at the beginning, it's not out of the question to see more spikes coming down the road. Stock prices and valuations are close to their highs, and without significant earnings growth, this leaves them vulnerable to correction, we think. And the Trump agenda has had little success so far at adding to U.S. economic growth as much as had been hoped. We've got Brexit negotiations, NAFTA renegotiation, tensions with North Korea, global cyber attacks, terrorist threats, all building in a blend of political uncertainty that confronts us on a regular basis. Well, the evolving inflation story, one of our important themes for 2017, has been perplexing. as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should also be growing, but this does not necessarily appear to be the case at the moment. Case in point, all central banks have a mandate to maintain price stability. Interest rates and monetary policy are used to keep inflation at targets of about 2%. Bank of England is dealing with inflation above that level. In fact, they announced this morning that August CPI was up 2.9%. So they're dealing with inflation well above target, but they're also dealing with Brexit and an economy that is stalling. Tomorrow, the Bank of England will announce their latest decision on interest rates. In Canada, real gross domestic product rose 1.1% in the second quarter, which put the last full year of growth at a rate of 3.7%, and that inspired the Bank of Canada, who believes that they have warranted a recent 2.25% increases in the bank rate, which is that white line on the chart. They also added in their press release on Wednesday last week that future monetary policy decisions are not predetermined and will be guided by incoming economic data and financial market developments as they inform the outlook for inflation. Particular focus will be given to the evolution of the economy's potential, to labor market conditions. Furthermore, given elevated household indebtedness, close attention will be paid to the sensitivity of the economy to higher interest rates. Well, as you can all see, the yield curve is flattening where 2-year and 30-year bonds yield spreads are narrowing. That, under normal circumstances, does slow economic growth and certainly reduces any inflationary pressures. And in addition, and we talked about this last week, Paul, and you might want to comment a little bit more on it, but the strength in the Canadian dollar certainly slows the potential for economic growth as well.
Yeah, for sure. I mean, it hurts exporters into the U.S., but I think, as I said last week or the week before as well, we do need to keep in mind on the Canadian dollar that on a trade-weighted basis, which basically takes all of Canada's trade with other countries and against their currencies and comes up with the Canadian dollar against those currencies. It's not as weak as a minus or an improved 12% or so as it is against the U.S. dollar.
Yeah, but also, on that note, and it's a good point, but another point to keep in mind is that Canada's biggest trading partner is the U.S. and they're...
Yeah, but it's still a trade-weighted basis. So
yeah, but
I think on a trade-weighted basis, we've only improved by about 4% or so. Nonetheless, there are a host of reasons as to why we are skeptical of the bank actually raising more. Some of it is the dollar Canada, the Canadian dollar against the U.S. dollar, and some of it, quite frankly, is the housing market, certainly in Toronto. And there are new mortgage rules coming into place. I wrote a blog, I think last week, semi-detached and condos seem to have found a bit of a base, and the average price actually improved this, Nick, but detached houses did not. And I think there's another, pile of supply coming online right now in the city of Toronto. Certainly I'm seeing that over the past week. So, this could be a real balancing act for the Bank of Canada. And NAFTA too, Scott.
Yeah, well, certainly NAFTA is a wild card, and we've mentioned that. In Europe, the European Central Bank held its benchmark refinancing rate at 0% last week, saying that a very substantial degree of monetary accommodation was still needed to support inflation. However, President Draghi said discussions on tapering the quantitative easing will likely start this autumn, despite the euro being a source of uncertainty for inflation. And as of last Friday, U.S. economic data so far released for the third quarter put expectations at about a 3% growth rate. I read this morning that analysts have cautioned that the impacts of Hurricanes Harvey and Irma could reduce that number by a full percentage point. So we'll have to keep our eye on how data comes. But one of the things that we've been talking about, and obviously the U.S. Federal Reserve is expected to keep interest rates on hold when they meet next week. But something we've been talking about again is yield curve flattening, and that's certainly happened as the Federal Reserve has raised rates. But something else, Paul, that we've been pointing out is that economic data, both hard economic data and soft economic data in the U.S. has not been showing signs of growth, but that hasn't deterred the stock market a whole lot, has it?
Nope, not since after the first quarter. Sometime in March or April. You can see the white line, U.S. hard economic data, and these are real numbers, whereas soft economic data, the yellow line, those are sort of more surveys or how people feel.
Confidence type numbers, right?
Sorry?
Confidence type numbers.
Yeah, confidence type numbers. But, what we've seen since March is both were trailing off. Now, obviously, the white line, hard data, did improve over the summer, but again is coming off through late August, early September here. But yeah, stocks continue to move higher to all-time highs.
And one of the rationale behind a lot of that has been the fact that there's a lot of liquidity still out in the global economy, and certainly the size of the Fed's balance sheet has provided a lot of that. The Fed buying bonds through their quantitative easing and holding them, but one of the things that we're going to be watching closely is how the Fed starts to reduce that balance sheet, and that will draw liquidity out of the system, and that could put some downward pressure on equity markets. Paul, you wanted to talk about this chart.
Oh, this is kind of an interesting one. The yellow line is, it's not labeled, but the yellow line is the S&P 500, and you can see again how it's been going up. The white line is U.S. money center banks, so all the big banks, they're commercial and industrial loans, so C&I loans. And it's not the biggest category of lending, but commercial and industrial loans would typically be to smaller type companies, probably a lot of private companies, as opposed to the big multinationals. And as you can see, through 2010 up to 2015, 2016, that C&I loans actually increased. And the reason why that is so important is because it means the banks took some of the money the Fed injected into the system and they lent it out to corporations. And that helps spur the economy. That creates growth. And that was all fine and dandy. Unfortunately, through most of 2016 and now the first 9 months of 2017, you can see that C&I loans have leveled out. It doesn't appear, for whatever reason, they may be nervous that it doesn't appear the banks are lending or increasing their lending at the same pace as they were the last 7 years. So it's not constricting, but it's certainly not supportive. And of course, again, what we've seen since late 2016 is the yellow line, the S&P, moving higher. So it's something, again, just to watch, and appears to be a little at odds. Now, some of the other U.S. bank assets that are much larger than C&I loans have continued to increase a little bit. So they are supportive, but certainly for small corporations, C&I loans are not all that supportive.
And of course, we do pay attention to the global debt situation. Our concern, of course, is that debt is at record levels, and interest rates, certainly in the U.S. and Canada, are rising. And that, to us, is, again, some modicum of concern. And of course, it's no surprise. We think U.S. stocks are expensive. we think earnings are growing at a reasonable rate, but certainly not enough to justify how expensive stocks have got. I listened to a call with Warren Buffett a week and a half ago where he said, it's the fact that bond yields are so low that's driving investors into dividend paying equities. But he also said that at this level, he's not interested in buying stocks. So there's something to be said for restraint at this juncture. Of course, we always keep an eye on the politics and what's going on. Certainly, we've been watching the Trump administration as it struggles to move its agenda forward. So last week, President Trump defied the Republican Party and struck a deal with the Democrats on raising the debt ceiling for a short term. So next up is tax reform, and we'll see what rabbits he pulls out of his hat to accomplish that. And as Paul mentioned, we are seeing lots of nuclear saber rattling. Today, North Korea rejected a UN Security Council resolution imposing tougher sanctions and said the United States would soon face the greatest pain it had ever experienced. A lot of noise, perhaps, but coming out of North Korea, we all have to keep our antennae focused on what's going on there. Paul, you talked about being on the brink of nuclear war. There's obviously you find this a bit frightening.
Let's hope we're not, but it's a potential reality that we may need to prepare for in our portfolios, and I think we have. Pardon me. We although the U.S. dollar has not behaved the way I thought it would have over the past couple of weeks, and I think I've done a fair bit of talking and thinking about this recently. Given what's going on in North Korea, the U.S. dollar should be catching a bid, but I think the market is so negative about there actually being a war that it doesn't care, that it's more concerned about central banks. And the fact of the matter is you've got, just in North America, you've got one central bank, the Fed, talking a lot more dovishly, which means they're talking about not raising rates as much. There are a couple Fed governors that have now said, we're getting concerned inflation is not actually increasing like we thought it would, which means they may not, probably won't, raise rates as much as the market thinks. Whereas in Canada, as you pointed out, Scott, we've had the first half of the year has shown better economic growth than the bank would have thought. So they're responding by removing some of the stimulus they put in a year and a half ago, 2 years ago. And that's driven the Canadian dollar stronger. And as most of our clients are aware, we did buy some U.S. dollars and sold some Canadian dollars just to snick higher than we are today on a spot Canada basis. And that should provide us with some protection if there is, in fact, some warheads being launched. So that I don't know. To me, that's the biggest tail risk in the market is the guy in the picture doing something crazy. So, and I quite frankly, my view is I think the U.S. cannot unilaterally attack North Korea, but I think what they will continue to do and probably ramp it up is try to get North Korea to do something first, and then attack. Either way, it's not a pretty situation from a humanitarian perspective, nor a financial market perspective. And I guess the other thing to add on our portfolio, Scott, we're still sitting on roughly minimum 20% cash, and that's been very protective.
Yep. And that is what we want to be. We want to be comfortable when we take risk. And as we've mentioned often, we're just not comfortable taking significant risk at this juncture. We would like to take risk when markets show us that it would pay us to take that risk.
Well, having said that, though, we still have risk on, and now this slide's a good slide to update some of the risk that we have on. In the tactical model, we still have what I believe are going to be some pretty impactful positions. One of them, I think there's something going on behind the scenes right now. So I'm hearing with my ear to the track. We just added, I believe on Thursday or Friday, we added to a high yield energy bond that we have owned for a while. It's a bond that we just bought at par. Unfortunately, that bond a year and a half ago, we bought it at 44 cents on the dollar. And that was like 2.5 fold, including carry for us. But I like this bond. I know the company well. I know the CEO. I spoke to her about 3 weeks ago. So we still have risk for sure, but our risk is what I would classify as what's called alpha risk. So it's not necessarily market risk within the tactical model. So there's special situations, there's storied credits or storied companies that you know, if there's nuclear war, everything may go down. But these are more special situations that we own in there, and they all have a story behind them and a reason for the investment.
Thank you. Okay, well, that's it for this week. We want to, as always, take the time to thank you for tuning in. We all know that everybody has a busy schedule. We have been trying to make this webinar more of a dialogue, focusing on topics that we think are worthwhile, and we would love feedback and obviously your ideas of what you might want us to discuss. So please feel free to let us know. We will be back with our next update next Tuesday. So until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week and a wonderful weekend.